Good afternoon, everyone. I'm Steve Seepersod coming to you from Binghamton University. So glad to have you with us here on this webinar Wednesday. This webinar is part of the Binghamton Learning Network series, and the program today is titled Shifting Gears, and we're so happy to have you with us as part of this program. It's one of the many lifelong learning offerings we have here through your Alumni Association. I'm going to go ahead and put our website address up on the screen right here, binghamton.edu/alumni. Of course, after the show today, check us out to see what it is that we have to offer. Quite a lot. This webinar series is just one part. We have a podcast series, an alumni travel program, the Tier Talk speaker series, but also through the Alumni Association, quite a lot that you can plug into to stay connected, stay engaged with the life of the university. We know you love Binghamton and want to stay connected. So we have volunteer opportunities, events in person, virtual events, all sorts of ways that you can make a difference. You can mentor students, you can continue to learn, as I know people like to do that throughout their whole lifetime. So of course, after the show today, binghamton.edu/alumni is our website, the source for all of these great opportunities for you to stay connected to Binghamton, and we hope that you do that. And we're glad to have you with us here today. So we know you'll have questions during the program. We want this to be an interactive experience. It's so much more fun when you're involved versus just me and the presenter. So definitely plug in. And if you have questions, start thinking them right away or start sending them. I'm going to put my email address at the bottom of the screen from time to time, just like it is here on this little banner graphic, sseepers@binghamton.edu. So if you have questions for our featured speaker, go ahead and send those in. You can start now if you want. But we'll take them all throughout the show, and we'll mix them in where it's appropriate to do that. It's not one of these, let's save it to the end type of things. We'll bring them in the middle, and the last 10 minutes or so will be dedicated to your questions, so keep them coming. sseepers@binghamton.edu, or if you're watching on Facebook, you can type your question in as a comment, or if you're watching on the microsite, you got a special custom viewing link. Go ahead and send your questions in there. So 3 different ways to get that done. And we will get your questions in where it makes sense to do so. And I know it's so much more fun if you're involved versus this just being a one-way form of communication. So again, start now if you would like. All right, let's let it roll, and we'll bring in our featured speaker in just about a second here. But the overarching question behind today's webinar and what we're meant to talk about in some level of detail is, how can you cope with planned or even unplanned income changes throughout your lifetime? And so think about shifting gears and going from basically a saver's mode throughout the time that people are working to a spender's mode once you've retired and are no longer working and bringing in an income. That's quite a transition for a lot of people and can be not the easiest to manage, but hopefully we'll make this a little bit easier. And as I always say, if we help just one person through this webinar, it was really worth it to drive down here and do this program today. Certainly, we hope we help more than one person. And so with that, we'll bring in our featured speaker. Say hello to Kevin Boda from the class of 2003. Comes to us from New York City. And I'm just going to read a little bit about his background, and you can certainly fill in much more. He had started his career in risk management and wanted to do something that he found more fulfilling. So he changed to a client-focused role and joining the Wealth Advisory Group, helping clients develop a financial toolkit. And so, Kevin, and warm Binghamton, welcome to you, even though it's quite cold here. It's probably about 20 degrees or so. We're so glad to have you with us. Thank you. And I'll toss it to you.
Okay. Thank you, Steve, and hello, everyone. And thank you for spending some time with us this afternoon. It's my pleasure to share some of the knowledge that I have with you, and like Steve said, maybe help some folks percolate some thoughts, put people on a good track, and maybe help them be prepared for some of the things that life may throw at us. So let's hop into it. I'll start out. I'll give you a little bit of additional color just on who I am. Professionally, Steve mentioned that I was at Morgan Stanley and Citi in risk management for many, many years. It's been really interesting to grow up in the risk world. I started pre-crisis, and obviously risk management changed very significantly, since then. After I finished at the banks, I spent some time trading my own capital. And I decided that I wanted something that provided a little bit more social value. And so that led me to explore a role with the Wealth Advisory Group, which I joined in 2004. Personally, just some interesting points. I have a lot of gratitude for the time I spent at Binghamton in particular. My girlfriend and I met at Binghamton in College in the Woods in Onondaga. She asked that I not put pictures of us up on the screen. So that means there are more pictures for my main hobby, which is motorcycle racing. And I kind of engage in two ways. I race at an amateur level, and then I also support a professional series called Moto America. And I've included some pictures on the right-hand side showing some of the time spent with some of the colleagues here at Wealth Advisory Group, different conferences that we've attended. And then on the bottom, you can see kind of where it started, this kind of motorcycle interest. And then you can see we had a large group of folks at a motorcycle round that was down at Barber Motorsports Park. And then the bottom picture is me on the track with the son of a friend of mine. This is interesting because what I always point out to people is motorcycle racing is more compatible with risk management and financial planning than you might think. And what I mean by that is it's a sport that rewards consistency, it rewards planning, it rewards preparation, and it rewards patience. And there's also a lot that happens behind the scenes for the things that you actually do get to observe. I just want to put that in perspective. What you think you might know, it may not be the full story. And it's somewhat similar as far as my role in the financial advisory space. People, when you say that you're a financial advisor, they tend to have some ideas about what that means, either based on their previous experiences, things that they've heard and read. But the approach that our firm takes and kind of the approach that I take is very comprehensive and probably a lot more comprehensive than you might expect. And a lot of times it has to do with coaching different areas, not just managing assets or taking a look at different products. So I want to plant that idea, and we'll talk a little bit more about that as we go through the rest of the deck. So I want to give you a little bit more about kind of what motivates me. And we have a little bit of a funny picture here, a guy sitting in a wheelchair, presumably something has happened, and he's saying, how much will this cost? Well, this is based on a true story. So my mom and her boyfriend were together for almost 20 years. They were excellent savers. They never really fully adjusted to retirement. They never got comfortable spending money. They continued to try to save money, which was a little bit easier for them because they had, solid incomes, but they also had strong pensions in their retirement. But as they got older, and her boyfriend, was 94 years old, when this happened, they started to, have more need for medical care, but they were a little bit reluctant to seek out some of the help that they needed. And there was one incident where her boyfriend had a fall and wound up in the hospital. And normally when people end up in the hospital, they're asking questions like, am I going to be okay? But I was kind of shocked that, the first question that he asked was, how much is this going to cost? And that really kind of hit me and made me realize, how important it is that people do have some degree of confidence and financial security. And also that they think about how to make the shift from, I'm working in a role and I'm receiving income in exchange for my labor, and I need to transition, and we'll take a look at this. There's a very good slide later on about now, how do I descend the mountain? And it can be difficult to do that. And so one of the things I'd like to do with the discussion today is give you some ideas about how to think about it, and what are some of the things that are very individualistic that are going to be unique for each person that they need to think about in order to develop a plan and try to address some of those changes that occur when income situations change. So there's an interesting framework. I shared an office with a woman who became a good friend of mine, and she introduced me to this concept of Johari window. And Johari window it's a social psychology technique, and typically the way this is used is that you pick from a list of adjectives, and then they get placed into different boxes, and you kind of see where you agree with what other people have said and how you've evaluated yourself, and then you take a look at how where there's some disagreement there. And so it's an interesting framework, and the reason that I wanted to bring this up is because it can help you evaluate some of the relationships that you have with money and with finances. And so it's good to think about this because there's a lot of psychology and there's a lot of emotion attached to money, especially depending how you grew up, what your work experiences has been, what challenges you've faced, what you've seen with other people in your life. And so there are a lot of different emotions that can come out of this. And it looks like the text on the pie chart got a little bit squashed, but essentially there are things that are in there, what are your personal habits and preferences? So are you a do-it-yourself kind of a person, or are you somebody who says, I don't want to think about this, let it be somebody else's headache? Some people have shame. Some people have made mistakes. If we pick on cryptocurrency, a lot of people say, man, I should have gotten in on Bitcoin 10 years ago. Hindsight is 20/20 vision. Sometimes we run across people in this space that have things that they're embarrassed about. They have a lot of debt. They don't have a good cash flow situation. Maybe they're in between roles, and so they don't have a current income. There are many things that go into it. So it's interesting to think about, what do you share with other people consciously, and then what do other people perceive? And you think about, okay, well, you may be saving for a specific goal, and you might be very kind of tight with how much money you spend on entertainment. And other people may take a look at that and say, oh, he's very frugal, he's very cheap. But sometimes if you share a goal with someone, and you let them know, hey, we're saving for a house, or we're saving for college, or something like that, it can kind of change the perspective. Very often we find people are reluctant to talk about money culturally, especially in the United States. It's something that people very often have reservations about. And one of the things that I think would be healthy to do is to open up that dialogue and share information and allow everyone to understand a bit more about what are some of the options that are out there, and what are some of the best practices that can serve as guideposts. So we'll move on. So building on the psychology aspect, I'd like to do a thought exercise. So wherever you are in your working life, imagine yesterday, your income stopped permanently and completely. That means that every day your wealth is going out the door. You still have to cover your planned expenses. You still have to cover your unplanned expenses. You're still fighting inflation, and you still have to handle things like the expense of medical coverage, which what a lot of people overlook is that employers very often highly subsidize medical coverage. So when people need to get medical coverage outside of their employer, it winds up being a lot more expensive than they expect, because they don't realize how much money their employer is kicking in addition to the premiums that they pay. And you have to live this way for 30 years. So the good news and the bad news is this is going to happen, and it's called retirement. And, that raises certain questions like, would you be ready for that situation? Or how prepared are you for that situation? Would that idea be more or less stressful than actually working? People talking about the stress related to their job, but when that kind of a significant change occurs and you lose your income, that could be even more stressful of a situation. So you need to be prepared for it. And then there are certain goals that we all have, right? A lot of times parents want to, help their children, their grandchildren, causes that they care about. Put Binghamton in there. I hope that everyone considers including Binghamton as part of their legacy. I know I benefited, and hopefully everyone else feels that they benefited from, the great public education deal that Binghamton presented. But everybody has things that they would like to accomplish. And then how do you do that in addition to just getting through what we would call regular life? So picking it up a little bit, I've put on here a number of difficult questions that often come up in conversations with folks. These are things that people are concerned about, and it's the usual suspects. Timing of retirement. What does retirement look like? Which is very individualistic. It doesn't always mean that you stop working, but usually it means that you may slow down the pace. Income topics, taxes, Social Security is a big deal. There are decisions to be made. It's not a binary choice. You get to, as I'm sure everyone knows, you get to pick your age, and the amount of benefit you receive is calibrated based on how much you've put into the system and the age at which you decide to draw benefits. Thinking about medical care. In some cases, people who think about this early enough will do things like put long-term care contracts in place and make other preparations. And then we talked about legacy. The good news is, for these difficult questions, even just having a conversation with a professional and somebody who's been down this road and has some experience can kind of help you get a handle on it and give you some good ideas. Very often a professional has what I consider the 4 different pieces that are necessary that usually drive people to get help from a professional in the first place. So they have the knowledge, they have the interest, they have the time, and they have the ability. And, there are different clients that I've worked with, and they're missing just one of these. But that means that they've recognized that they need help from someone who can give them all 4 of these and kind of fill in that gap. So moving on, I promised that we would do some myth busting.
Oh, Kevin, I'm sorry. Before we go on to the myth busting, I just have a question, and it ties into something we saw 2 slides ago on the thought exercise. And I'm curious, based on what you have observed with clients that you've worked with, are people putting off these thought exercises, these conversations, just because now it's like people are working longer, you're getting pinched on both sides with helping kids through college and getting set up for their successful adult life, and at the same time the generation above them taking care of parents and all these pressures, forcing them to work longer, just saying, well, I get to that whenever because I'm going to be working longer. I don't need to really think about that right about now.
Absolutely. People are busy, and one of the things being in this line of work that I've observed is that people are expert procrastinators. There are very few people who are going to have any kind of retirement planning at the top of their list. The only people who have that as a burning priority usually are people who are, imminent and realize the short timeline that they have left, or they've already retired and now they're trying to figure out what to do. And what I would caution everyone about is that this type of work and this type of planning gives you the best results when you do have a long enough runway in order to put the right pieces into place for a credible plan that will be, keeping your options open and will also be resilient in case things don't go, according to your best case scenario. The way that we see that come into play is we see people kind of who have underemphasized a savings program and setting money aside and letting it grow with the power of the time value of money. And instead they scramble for rate of return. And it's a very dangerous game because higher rates of return represent higher risk. And so very often that can jeopardize, the situation that somebody is in and lead them to a worse outcome. So I'll show an example a little bit later on about how sometimes playing it safer gives you a little bit of a better outcome. But it's important to make sure this is on the list and try to knock it down. The number of people I talk to that say, I ask them, do you have an estate plan? And the answer 90% of the time is no, but I really need to. I've meant to do that, for the past, 1, 2, 3, 5, 10 years, inclusive of having, a will and all the legal docs, et cetera. So no time like the present. And to be fair, that's one of the reasons that people engage a professional as well is accountability. If you think about it as like, if you've ever had a gym partner or workout partner, somebody that you do have some accountability to, the good news is that once you hold yourself accountable to the process, number one, there's an absolute financial benefit, and number two, it feels really good once you've done the work. So my advice is don't wait. So let's move into the myths. So Steve touched on this earlier, talking about how there are cases where you haven't formally entered retirement, but there are changes in income. I've seen this trend with a lot of folks who are mid-career. There's a term that I started to hear a couple of months ago called micro-retirement, which is essentially a rebranding of a sabbatical or a career gap. And so the people who are able to do that and kind of recollect themselves and retool and move into other roles are the people who have been strong savers, who have put together some sort of a plan, and they have some resources that they're able to lean on. They're not necessarily stuck kind of on the treadmill. And they've also usually done a good job of managing their lifestyle compared to the level of income that they have. Doesn't necessarily mean they make a lot of money. It means that the amount of money they've been able to save allows them a little bit more flexibility and freedom. Moving on, I'll be in a lower tax bracket in retirement. I certainly hope not. There are a number of things that people overlook when they're considering tax brackets. Usually in retirement, you've lost some of your write-offs, your dependent credits, mortgage might be paid off. You no longer have the ability to deduct that. Some qualified contributions. You're going to have, depending on where you are, additional income from Social Security. You're going to be forced to take required minimum distributions from certain qualified plans retirement plans that you may have participated in. And you'll have hopefully some investments, and those will generate some income that will also contribute. So what I always tell people is that unless you are strategically depressing your income should probably be higher in retirement than it is during your working years. And certainly, for my mom, that's the case. She complains bitterly about having to take her required minimum distributions. And she's never made more money in her life than she is in retirement. The next one, I don't have enough assets to engage a planner. Then my question is, then how are you going to get there? If it hasn't happened so far, then that usually is an indication that there's some work to do in the cash flow space. And that's one of the areas where we spend a lot of time with folks, helping them to optimize each dollar that's coming onto their balance sheet in order to work toward the best possible outcome and build up that asset base. There are some shops and there are some advisors who will only accept clients that have a minimum level of assets, but that's, I would say, not, only a portion of the population, and those may not be the best folks that are a good fit for you anyway, if that's a concern. I may not want to work with somebody if that's the most important qualification, is just how much money do I have, because the goal here is to grow and build wealth, not just to have and manage wealth. There are a lot of opinions out there for the next one: fee-based versus commission-based. And the color that I'll add to this is that as an advisor, it really, I don't have a preference economically. It's probably going to be somewhere in the same ballpark. But my view on the role that I and folks from our firm play in the lives of our clients is that it's a relationship. And there is some work that's been done to show that having an advisor is well worth the expense when it comes down to the outcomes, the numbers being tracked over decades of time. But when it comes to fee-based and commission-based, fee-based, essentially building a plan for a fee and then deploying. And then, we don't always know that the plan is being followed. And more importantly, things can change. So I think we enjoy having regular contact with clients and also being a resource for things that may not fit strictly within a fee-based structure. So this is one where there's no necessarily right or wrong answer. It's based on client preference, but it's a factor to consider about, is this a resource that you can leverage across many different domains, not just for managing assets or acquiring different types of products and assets. Financial advisor isn't worth the expense, as I mentioned. There has been some work to understand this. Very often it has to do with maintenance and things like sticking to a rebalancing program, which can yield better results, especially when there are significant moves over the course of the year in a market, and making sure that the strategy, number one, still makes sense, and number two, that it's optimized. I'll move to the next one. This product is bad. Take your pick. There's criticism out there about just about every single product or investment that you can make, and you can talk about individual single name stocks. You can talk about different types of index and ETF products. You can talk about annuities. You can talk about different types of life insurance, disability insurance. My point on this is that it's not necessarily the product, it's the use of the product or the abuse of the product. So, a product is just a tool in the toolkit that you can use. Some things have a broader use. Some things have very limited use. And this is where it's important to understand how things work. One of the reasons that people have bad experiences is either because they don't have they haven't been given a full understanding of some of the pitfalls that can come up in the lifetime of a product, or they don't necessarily understand the risks that they're exposed to, and that leads to negative surprises. So, there are things that have bad outcomes, but I would be careful to dismiss a class of products that can be useful just based on anecdotal evidence. The next one I love. I can only gift a certain amount of money to my children tax-free every year. There are two problems with this one. Number one, that's not the limit anymore. 2025, we've gone up to $19,000, which is substantial, and that's to children and grandchildren each. So if you have a lot of, if you have a big family, you can give them a lot of money without worrying about taxes. But the second issue is, you can give up to the current estate tax limit under an exemption. You just have to report it. This is the same thing as one of my other favorites, that when you return from overseas travel with, let's say, bottles of alcohol or cigarettes, that there's a hard limit on it. No, you just have to declare it. And then in most cases, they're not going to, I've never had Customs and Border Patrol actually levy a tax against me for the dozens and dozens of items that I've brought in and declared. So you just have to declare it. This is an unfortunate one because usually it delays the transition of assets to a younger generation until death. And very often there are situations where it would be more beneficial to accelerate that process and not have to wait until, an unfortunate demise in order to see that happen. The second to last one, I need $2 million to retire securely. I see these articles all the time. There's so many factors. It's so individualistic that there's no single number. Everyone has their own number. And part of the work that you can do to prepare for retirement or even a micro retirement is understanding what your actual cash flows are and understanding what your actual needs are to cover your lifestyle. And so that's where managing lifestyle becomes very important. The last one, I can safely withdraw 4% of my assets every year in perpetuity. That's the 4% rule. And this became very popular to say, this works. And the bad news is it doesn't. There have been some articles that I've read lately that say, well, maybe it's more like 3 3/4, maybe it's more like 3.5. The bad news is there's no magic number. The good news is there are ways to deal with it. We're going to take a look at an example in an upcoming slide.
Just want to jump in here, and if you don't mind, just taking us back to the slide here with the myths, because some of these are really quite interesting and almost comical to take a look at and get into. Looking at one of these here, I don't have enough assets to engage a planner. In other words, the planners only want to work with wealthy people. People have wealth already. I think if that was true, there'd be a lot of financial planners out of work because there would be a much smaller pool of people to work with. versus trying to make it much more inclusive, or, this product is bad, or you're looking at fee-based versus commission. And people sometimes have a mistrust of things that are commission-based and say, if the planner is pushing this and suggesting it, it's because it's going to draw a commission for that person. And they're not inclined to think about, well, they're suggesting it because they think it would be good for me. They think, well, they think it's a good deal for them. That's why they're bringing it up. And so I think that can be a self-defeating way to approach it. And it feels like some of these are almost driven by like the scarcity mindset of, I don't have enough assets to get a planner to work with me, because they want to work with millionaires, or I need 2 million to retire. Thankfully, that's not the reality. Or quite a lot of us would be working until the day we pass on. So that would be very discouraging if that actually was the case.
Agreed. And if that's what you want to do, then you're free to do that. But very often people have other ideas about how they want to spend, their time. So this is an interesting slide talking about accumulation versus distribution, and it's very different. And kind of the analogy that I use very often, having skied and snowboarded for many years, is, how you get up the mountain versus how you get down the mountain. And going up the mountain, typically you're taking a lift up. I have some friends who actually will skin up mountains to get first tracks, but that you're talking about, a very, very small fraction. Normally, the lifts are taking people up in mass, and then on the way down, that's where it gets a little bit more treacherous. And kind of a I'm not going to call it a fun fact because it's not really fun, but when people are doing mountaineering expeditions, for instance, climbing Mount Everest, more people die in the descent. It's not the trip up, it's the trip down. And when you think about my skiing analogy, people can take all different paths down the mountain. You can go through the glades, you can go through the park, you can take a green, you can take a double black, you can go on moguls. And so distribution, that phase is a lot more challenging because there are more factors. When you look at some of the things that are different about when you accumulate money and when you're distributing money, it really flips. So usually when you're accumulating, you're thinking about dying too soon. There are ways to address that. Things like, life insurance being one in case you do have a premature death. But usually people are concerned about, I'm going to live too long. I'm going to outlive my money. Illness and injury, it can affect your income, but it can affect your assets. And as you see, in the accumulation phase, your cash flow is building your net worth. In distribution, your net worth is generating your cash flow, whether it's asset drawdown or whether it's kind of earning a return. Volatility, when you have a long timeline, volatility is great. That can make you money, and you can sit out downturns in the market. It becomes a lot scarier when your net worth is exposed, and you basically need to draw on an asset. Tax deferred vehicles, they're great when you're accumulating money. As I mentioned before, when you have to deal with things like required minimum distributions, they can be very painful when you're in the distribution phase, and it's actually a pretty bad way to pass wealth generationally. So, if somebody's inheriting a qualified plan like an IRA, after Secure Act 2.0, there were some changes, and the stretch option was removed. So now anybody who's getting a traditional IRA as part of an estate is inheriting a significant tax liability in most cases. And then inflation. Inflation is less painful when you're earning money because your salary rises in hopefully in some way alongside it. You don't get that same benefit when you are in the distribution phase. So just some things to think about here. Let's talk strategy. Accumulation. What are the things that we like to do with folks? Number one is protect your most valuable asset, which is your income. Three ways to do this. Group benefits are very powerful. You should make sure that you understand what your benefits are, and that you have signed up for them. I know people that I used to work with that were very comfortable not even signing up for health insurance. Blew me away. There was one guy that had a very serious injury, and it had a very significant impact on his financial position because he had foregone health insurance. Not a good idea. There are other things like disability, retirement plans, and so on that you should take advantage of. In addition, you should take a look at individual life insurance and individual disability insurance. And we'll take a look at why for the disability a little bit later on. For life insurance, the way to think about it is that you have what's referred to as a human life value. You have an economic value that represents your earnings throughout the rest of your working years. And if for some reason you're unable to actually work, and there are three reasons that you can't work, right? Lose your job, you can get another job. You get sick, that's when disability insurance can kick in, or you die. And then you may have people that are depending on you, and you want to make sure that you fulfill basically your financial commitment to them. That's where life insurance comes in. But additionally, certain types of life insurance can have a growing cash value that can provide benefit later on. Number two, I mentioned this before, high rate of savings. It's critically important. So you should evaluate how much of your income you're actually able to set aside, and think about whether that's something that you can start to increase slowly to get closer to what good looks like. The last one is think about diversifying your assets. So we distinguish between foundational wealth and at-risk wealth. And you can think about this as things that are, uncorrelated with the market versus things that are intentionally exposed to the market. In the simplest case is, if you have cash. So if you have adequate liquidity, the rule of thumb that's popular is 6 months of basically, expenses in the bank. And that is not exposed to the market. So if there's a market decline, you're not going to get hit. At least that portion of your wealth will not be hit. The last one is about risk tolerance. Very often you want to make sure that you stick to a reasonable plan and you don't necessarily overcommit to overly risky assets just because of, let's say, near-term performance. On the distribution side, it's a little bit different, but thematically there are some similarities. You want to make sure you have diverse assets in retirement. Usually we think about 3 different buckets, right? Guaranteed income, so things that are coming regardless of what happens. True liquidity, which gives you some optionality, and growth in income, which allow you to kind of keep pace with things like rising prices through inflation. You do want to manage your tax burden, which is another important piece, especially given what I mentioned before about losing common tax write-offs. And you want to factor in the impact of required distributions for qualified accounts, as well as social benefits like Social Security. And then the number 3 under the distribution side is you want to optimize to your goals. And typically there's somewhere in the spectrum of maximum income versus maximum legacy. This can include spending down your qualified accounts, because those can be very inefficient to leave to other people. You want to have a plan for different phases of retirement. I have a friend who talked about something you may have heard of. You have go-go years where you go and do all the things. You have slow-go years where you're still able to do things. And then you have no-go, where you're limited in what you can do. And each of those is going to be distinct, almost like another phase inside of retirement. And then at the end, think about what are the tax efficient ways to pass wealth. Talk quickly about disability. In this chart, the blue bar represents your current income. The green bar represents your after-tax income. The dark blue bar represents the typical coverage through an employer-sponsored plan. The dark pink represents what you would actually get once you consider the impact of taxes. And the light pink is the gap that exists. And so this is why it can be worthwhile to think about individual disability insurance, because number one, it's portable, it's not tied to your employer. Number two, it allows you to basically close the gap between, what you were making and what you can expect to make, or what you can expect to receive in a disability scenario. And people think of disability as like the picture in the beginning of the presentation. I'm injured, I'm in a wheelchair, in a cast. The reality is that it's usually related to things like, like disease and chronic conditions. So, there are unfortunate situations of folks that have had, bouts with cancer. I'm sure everyone, I've worked with people that are no longer with us due to an experience with cancer, and it's preceded, by, a period where they were unable to work. Having disability insurance allows you to maintain your income and continue moving toward your strategic goals, even if you're unable to work in a traditional job. Life insurance. This could be a whole detailed conversation. We're not going to go into that. There are basically three different groups that I consider: whole life, universal, and its variants in term. Term is pure insurance. Term is, for a period of time, I pay a premium, I get a death benefit, I either die or I don't. If I die, somebody gets the money. If I don't, then the insurance company keeps the premiums. Whole life is you get the most guarantees. You have a level premium. It's called whole life because it's intended to be there for your entire life, age sometimes 95, 99, or age 121. And there's a point of what's called endowment, which is where the cash value hits the death benefit, and it happens at whatever that contract specifies. Usually it's one of those three ages. And so you have a guaranteed death benefit in that as well. It's a useful tool. Very often when we work with folks, it's a combination of whole life and term, and the term usually put what's called a conversion rider into it, so they can convert it to whole life later on. The reason we do this is that it avoids the medical underwriting process, so that if let's say you have a condition that develops later on, you're not constrained in being able to get insurance. Not everyone is able to qualify for insurance, and so it's something that we like to explore with folks just to see if it's an option while they're still relatively younger and healthier, wherever that may be in their life. Quick example here. If we think about two individuals and some very basic assumptions, they each have $1.5 million. On the left side, they wind up with putting it all into kind of the market, all into S&P with dividends. On the right side, it's 1.2 million in the market, and then it's 300,000 in what we're calling true liquidity, which we're assuming earns 4%. And the surprise here, the counterintuitive thing, is that I kind of had some fun with this, and I said, okay, if instead of going to Binghamton in 1999, what if I had that money and I was trying to figure out what to do with it. And unfortunately, there were a couple of bad years, 2000, 2001, 2002, if you guys remember. And so if you had all of your money in the market, then that would put you behind somebody who had kept some of their money out of the market. And additionally, when you're trying to generate income off of your $1.5 million, when you draw against a depreciated asset, it becomes very, very hard to make that up. And so we see that where, we're kind of behind on the left side, that the yellow box, the 922, 970, is 10% lower than the $1 million that remains on the right side. We continue to draw on both sides, and starts to catch up on the left side until we get to 2008. There's another, 2008 was a kind of a record bad year, and it winds up being even more harmful. The interesting thing here is that this actually goes out, this hypothetical simulation until 2023, and the left side never catches up. So a more conservative strategy, by keeping a portion in cash, by keeping true liquidity, gives you a better result and a safer result than taking more risk. And so what I mentioned before about people getting nervous as they get closer to retirement and taking more risk usually doesn't wind up being a good idea. The other thing I'll note is that the assumptions that I used on this were very conservative, and the more we change those assumptions, the better off you are being on the right side and preserving some portion of your capital in true liquidity, as opposed to having it kind of all exposed to some combination of market sensitive assets. Very quickly, impact of taxes. This is another example of asset coordination. So if you only have a 401k and you withdraw money from it, this may be under the context of an RMD or maybe not. The government has allowed you to defer the tax on that money. You are joined at the hip if you are in a traditional qualified account with the IRS and you are making money for them and they want their cut. In this case, we're making an assumption that it's $32,000 that you're going to pay in taxes. And so of your 100 grand, you only get $68,000. If you consider similar sums across different kinds of assets, then you're able to draw partially on, in this case, your 401k, still pay the same rate of taxes, but the absolute value of the taxes is lower. And if you had a whole life policy with cash value that you could draw on, then you're withdrawing the same amount of money from your pool of assets, but your tax bill is much lower, to the tune of $16,000. So this is another example of how diversification of your assets in retirement can give you a substantially better result. The last point that I'll make here is on generational planning. Education, 529s are very popular. Just be aware that there are some limitations. We run across folks with a moderate frequency that went very heavily into a 529 plan, and then good things happen. Maybe their children got scholarships. They didn't have to use it. Now the money is, I'm not going to say stuck, but there are only certain things you can do with that money without realizing the tax liability. When we think about gifts, we talked about the fact that you are able to gift above the limit, as long as you disclose it to the IRS and they keep track of it, so that it goes against the estate limit. Of course, the limits are very high right now. That may change in 2026, but those are still pretty big numbers that most people are within. And the last point is trusts can be a useful tool. They let you, control, as they say, from beyond the grave. You can put rules in place as to how your wealth is used when it outlives you. It can help significantly with tax issues if you set up a trust in the correct way, and it makes the process a lot easier by avoiding probate issues. The downside is you can have complexity and cost, but it's another tool that is potentially used in the toolkit. It's worth considering. In some cases, you can combine the two, and I'll make another plug for including Binghamton in your legacy. There are ways to structure it so that charitable gifts, to an institution like Binghamton, can provide you with a benefit while you're living, and then the charitable cause, receives the benefit after you pass away. It's worth exploring. I think Binghamton has a pretty good program for folks that are interested in that. Last slide, action items. So what should you be doing? Number one, think about your plan. Do you have a plan? Do you want a plan? What does it include? Number two, some of the questions that we looked at before, try to answer them. It's tough. People don't want to do it, but you're going to have to do it, and it's better to do it now before your back is against the wall, and decide on how you want that to be. The third thing is educate yourself. Some people will love to do this. Some people will hate to do this. And if you decide that it's not something that you want to do, then try to figure out if there's somebody that you can use as a resource. And then the last piece is engage in estate planning. Again, this is not a process that I would describe as fun. I think it can be fun. I think for most people, it seems like a bit of a chore, like the same way that doing taxes is, but there's a huge benefit to doing this as far as understanding that you're on top of your financial future, and understanding that the intentions and goals that you have will be addressed. And that's it. So apologies, Steve. I think I ran a little bit over the time that we had expected, but I do have some time for questions, and so I'm happy to field any of the questions that have come in while I've been talking.
Well, Kevin, thank you so much. And I've put my email address back up at the bottom of the screen, and we'll take some questions. Even though we're coming up on the top of the hour, we can go into a little bit of bonus time just to get some of these questions asked. So be sure to get them in, because time is somewhat limited and we don't want to leave you out. So one question that has come in, and probably very specific to the person, but I'll leave it to you as the expert, is in regard to Social Security, am I better off starting to take the payments at 62, or should I wait? Because certainly you wait, you get a higher payment, but if you start taking the money now, you can build up a larger amount over time. So I'll toss it to you for that one.
Sure. So I'm not being evasive, but you're correct. It is very situational. It depends how large of a component it is in the overall plan, and it also depends on what are the implications as far as things like taxes. So I think the standard advice is wait, get a higher benefit, but there are situations where perhaps somebody has retired early, and they've had a gap that they've had to fill in before they're eligible to receive Social Security. And so it can make sense to claim it earlier. And it also depends what you're going to do with it. If it's going to go out the door, then it may be worth it to wait until you can get a higher amount, and hopefully you can hold on to some of it. If the intention is to basically use it for what I'll call productive purposes, then it can be worth it to take it earlier, and then you can use it to do things like acquire assets that can give you a higher income than you would be able to get even if you waited and took it later. So lot of levers there. I'm sorry if that wasn't kind of as decisive of an answer, but this could be something that's worth a chat offline. And it really depends also what your objectives are, especially for that portion of the money.
Tough to deal with that in a broad brush, and certainly if somebody needs money now, they need money now, and there's not a lot that can be done about that.
Mm-hmm.
So the next question is, and earlier you talked about some different tools available to people, oftentimes offered within workplaces. And so if somebody's employer offers a traditional 401k or a Roth 401k or both, which route is better? Probably this is individual to the person too.
Yes and no. So I tend to favor the Roth structure, and there are a couple of reasons for that. Number one, what people may not realize is that if you have a Roth, then you probably have a traditional as well, because if there's a match from your employer, then that is going to be pre-tax. And so it's going to be put into a separate account, and there will be tax due on that. So effectively, if you have a Roth and you have an employer match, you also have a traditional. Having both of them actually gives you some flexibility because you can decide kind of how to sequence the withdrawals from those accounts. But the traditional advice that I would give is you want to aim to spend down your traditional accounts, before you pass away. The other reason I like a Roth is because it's at least not currently, and of course legislation can change this, but it's not currently subject to required minimum distributions. I know there's been some talk about putting caps on the amount that can be held within a Roth because there were some very remarkable figures that people had accumulated inside of Roth, and there are questions about whether that was appropriate. But it's a very compelling proposition that in a Roth, the tax issue has already been addressed and you have full flexibility. It's up to you. It's not up to anyone else as far as how and when that money is used. The other thing is that it's very common. It's shocking how much money is collected in early distributions from qualified accounts. It happens that people need the money, like I'd mentioned before. Liquidity is important. A lot of people don't maintain adequate liquidity. And so when they need liquidity, then they start looking at their assets, and then they have to draw down from a qualified account. One of the kind of nuanced details is that there is a 10% penalty on top of ordinary income treatment when you are withdrawing from a traditional IRA or a traditional 401k. In a Roth, as long as the money has been in there for 5 years, you're able to access the money that you've contributed, not any of the earnings above and beyond, but you can access that without penalty. So it gives you a little bit of flexibility in that as well. Not that I would recommend that you do that, but if that's your only option, then at least you're not going to get hit with what I'll call wrong way risk. There are also benefits when you think about passing that asset to, a beneficiary, because it's post-tax, then, there are kind of fewer strings attached to it. And so it winds up being kind of a better vehicle. So those are some of the factors that come into play that lead me to kind of more often recommend a Roth if it's available to you than a traditional.
At this point, it's 5 minutes after the top of the hour, so we'll just go ahead and do 2 questions quickly, and then we'll sign off. But I'll leave my email address up here for another minute or two. if you want to send in a question, I'll forward these to Kevin and we'll get it taken care of offline. But I won't be able to get any more in without keeping us much longer than we're able to really stay. But we've got a question regarding 401ks. If getting an inheritance from a parent in the form of a 401k distribution and rolling into my IRA, what kind of distribution schedule should I anticipate? The person asking is 57 years old. I heard taxes need to be paid over 10 years. Can you clarify?
Correct. So I had mentioned before that the stretch option no longer exists, which I find a little bit of a shame. And so yes, if you receive it, you have 10 years to basically pay the tax. The IRS wants their money, and so the painful part of it is that very often when people are inheriting these things, it's during their peak or their near peak earning years. So it's very painful because you're in the highest tax bracket that you're going to be in. So a little bit of planning around, a little bit of strategy around, what bracket are you in, making sure that you, avoid some of the big jumps between brackets if it's possible, by strategically pulling a certain amount in and recognizing that income. Is one way to deal with that. This is another case where it's a little bit specific as far as, the amounts, the amount of time, things like that. I'm happy to have a conversation or to take a look and give some more specific advice, kind of offline.
And we'll take one more question that just came in. But like I said before, if you're typing up a question, you have an email going to me and I don't get in during the show, I will definitely pass it along to Kevin and we'll get your question answered. But this question from Bill, say you have a significant six-figure nest egg, whether inherited or aggressively saved in your mid-career. What are the general financial implications of taking a 4 to 5 year gap in employment for pre-retirement? Will that delay true retirement age by the same number of years of the gap? Twice as many years, half as many, or is the question too complex for a simple answer?
So the reason it depends is it really depends what you're doing with that money, and it depends how much you need to support your lifestyle during those years, and are you drawing down on the assets? Are you able to generate income to support yourself? In general, it may have the effect of delaying, but that's exactly the kind of a thing that we can and do and have modeled for folks that have been looking at that type of a scenario. This is a case where it makes sense to take a look at specific numbers and kind of plug them in and evaluate. It's tough, but I would say without any additional information, it's probably going to mean that there's some additional years in the back end, unless there are steps taken to compensate for that. The describing it as a nest egg leads me to believe that it's getting fairly conservative treatment. So it might be hard to support a lifestyle off of that amount of money, and not have to pay some price later on in terms of extended work.
Well, that'll bring us to the end of the webinar for today. And Kevin, thank you so much for being with us. And I know you're very passionate about Binghamton University and wanting to help other alumni and about staying connected to us. And so we appreciate your time and the generosity of sharing your expertise with us. Thank you so much for being with us on the webinar today.
Yeah, much appreciated, Steve. And thanks everyone for hanging on, even though we ran over time. This was fun. And, I'm very happy to be a resource for anybody, in any way that I can. So all those questions that have come in or may come in, we do consultations without charge with folks and try to present our best ideas. And so there's a lot of information exchange. So find me on LinkedIn, send me an email. I'm very happy to talk and give you the best advice that I can.
And one question we get a lot of, and I have this link here at the bottom of the screen, is the program going to be available afterwards? Absolutely. So it's recorded, it's archived. So if you go to our microsite at the address here on the bottom of the screen, that's the place to check out today's webinar and all the others we've done. Quite a lot of content there. If you had been watching on our Facebook page, on the Alumni Association Facebook page, Facebook will automatically save it and the program will be there as well. So check that out. If there's anything that you feel you need to revisit or go look at slides or jot some information down, it is there for you and will be there. So very quick, and I know we ran into some bonus time, so just 1 minute more on some upcoming programming notes. We have a webinar coming up 1 month from today, Wednesday, March 5th at noon Eastern, and this is going to be turning tension into trust. So if you are the parent of a teenager and find that it's a little bit tougher to connect with them than maybe it was at an earlier age, we have a licensed clinical social worker who's an expert on this topic who will be our featured speaker for that webinar, Tension into Trust. We have 2 webinars coming up April 1st and April 2nd that are part of Binghamton's Success Week. Both of them deal with artificial intelligence, AI, and the impact of AI on people's careers. So if that's something of interest to you, we have 2 programs, April 1st and April 2nd, that delve into that topic. And we're working on a Tier Talks event that's going to be online for sometime in mid to late May. The date is to be determined. We'll get that figured out very soon. And the topic is going to be food insecurity. So if that's something that you have an interest in learning more about in terms of a macro level, what's happening countrywide or globally in terms of food insecurity or what's happening close to home in your community, that's a program that you'll want to plug into. It'll be a 5:30 Eastern start time, most likely on a Tuesday or Wednesday or Thursday in mid to late May. So more on that to come. And probably by the time we have the next webinar, we should have the date in place for that May Tier Talks. So we will pass that along as soon as reasonably possible. So thank you so much for joining us here this afternoon. It was great to have you with us. And I hope that you found the information to be valuable. And so certainly, as Kevin mentioned, if you have a question, look for him on LinkedIn or send him an email. And he's always happy to help people in the Binghamton University alumni community. So for Kevin Boda, I'm Steve Seepersod. Have a great rest of the day, and we'll see you in a month at the next webinar.